Hi, Jeremy Surrier here, and this is CRE Invested Module 8. In Module 8, we're going to be talking about commercial foreclosures. And in this module, I really want to emphasize that when you're looking for a commercial foreclosure, it may or may not necessarily be a deal. The reason for that is that a lot of people look at foreclosures and they say, well, if it's distressed, it's got to be a deal, there's got to be money to be made, but that's not always the case. In fact, what you'll find is that sometimes the property has significant drawbacks and issues that even if you buy it at a very low price, it still may not be a moneymaker. So with that caveat, we're going to go ahead and move forward into this module and talk about a few things. One thing we're going to cover is the mechanics of the commercial foreclosure. Exactly how does the foreclosure process work? Should you be focusing on debt or collateral when you're looking at commercial foreclosures? The three formats that banks use: notice of default, forbearance notices, and lis pendus. We'll look at lender prospecting. We've got a great online tool you can use to go in and find out which banks have distressed deals for you to look at. And we're also going to talk about navigating auctions. And then lastly, we'll wrap up by talking about risk and how to plan your flip. Now, what's going on in the market is you have this massive swell. It looks like kind of like a wave of loan maturities coming through. And as you know from our previous module where we talked about the 469 rule in module 2, we actually looked at this in and of itself. And what you're seeing here in this commercial mortgage maturities chart is the loans that were originated and when they are coming due. And what you'll see is that there is a huge amount of loans that will be coming up from the 2012 to 2015 and 17 time frame. And one of the things that we're going to talk about is how to get to the blue section here that you see, which is the banks and the loans that they have coming up. Now, when you're looking at commercial foreclosures, starting with the fundamentals, you've really got two components that you're managing. One is the equity that's the down payment money that the owner has put into the deal, and then you have the first mortgage. That's the money that the bank has invested in the deal. And I want to pause here for just a second and talk quickly about the bank. When you're looking at banks that are in distress, one of the things that you need to keep in mind is that banks are investors. They're just like you and me. They're looking at deals and they want to make money. And the way they make money is by lending money on buildings. They just like to lend less than what the building's purchased for so that they have some room. That's that spread in the capital stack that you see between the green and the beige section. And what that allows them to do is to protect their investment while also generating a return. Now, when the owner stops paying the bank starts losing money. And when the bank starts losing money, one of the things they look at is the property. They want to recover their capital, and if it requires going in and wiping out the owner's equity by taking the property back, that's one of the recourse items they may take advantage of. Now, when the bank starts to take action, one of the things that they will do is they'll add fees and interest on top of the amount of money they're owed or their principal balance in the capital stack. Those fees and that interest, that's designed to protect their investment in the event that the owner is able to reinstate or work some kind of deal out. They're creating a way for them to recover some of the costs that they've incurred in lost payments. Now, oftentimes the owner is unable to reinstate their loan, so what ends up happening is the bank has to plan for an auction, but before they can do that, they have to go through a series of steps to give notice to the owner that they are in fact planning on taking the property back. Now, what you've seen a lot of in the past several years are banks taking loans and extending them or entering into forbearance agreements. Now, when the bank does that, they're really postponing the inevitable, which is getting the owner out of the property, taking the property back and then selling the property in order to recover their investment. Now, your opportunity is to step in when the owner has started missing payments and to approach the bank and start to work out a deal with them. And the opportunity that you look at here is going to the bank and trying to restructure the deal. Now, a lot of times you're going to hear about taking possession of the property or assuming the loan or just getting the deed to the property for a nominal amount of money. I want you to know that when you're dealing with commercial foreclosures, it's not as simple as that. These banks are sophisticated. They have sophisticated legal teams, and you need to make sure that you're doing things above the board and legally and ethically. If you're going to go and take over a property, just make sure that you are taking it over and notifying the bank that the property is under new ownership, and if there is an assumption on the loan or some restructuring that needs to take place, it's important that you do talk to them. Now, when you do step in and take control of the deal, there's an opportunity for you to pick up some discount, and that discount is primarily measured either by the bank reducing the fees that they've charged, the back interest they've charged, or they've agreed to restructure the principal amount owed in order to maintain and preserve their investment in the property. That, for you, poses an opportunity to gain equity by taking the deal over. Now, you've got two formats that you can approach the bank with. You can actually go after that green portion, the capital stack, and deal directly there, or go after the property, or what we call the collateral. Now, when you're going after the loan, the debt, you're really looking at doing a note buy or a debt deal. And when you do a debt deal, these are also called loan to own, you're buying the note directly from the lender. And if the note is distressed, oftentimes the note will be discounted. The lender will sell it to you at a lesser price, and they do expect you to come in and pay all cash for the property, or actually for that note. So when you come in, you got to be prepared to perform. They want to close in 2 to 3 weeks, and they want you to step into their shoes and take control of that first position. Now, what a lot of investors do is they'll come in, they'll buy the note, and then go ahead and foreclose on the owner by enforcing the recourse. One example of a deal that we were involved in, and we actually didn't get, but came close to getting, was a large multifamily project that was actually a student housing development in Portland, Maine. This project had a $20 million construction loan that had recently converted to a permanent loan. It also had a $4 million mezzanine equity loan on top of that $20 million loan. So if you imagine that capital stack we were just looking at, that green section on top, that was the first mortgage. The second, that mezzanine, was on top of that. That was the $4 million component. And what happened was the developer hired the wrong managers, mismanaged the property, and the property failed to stabilize. And when they did that, they defaulted on the $20 million loan. That threw the mezzanine portion into really into second place, and they ended up losing their money. But the bank, KeyBank, turned around and said, we're going to sell the deal, and in fact ended up selling it for $9.3 million in cash. Within 18 months, the guys that did get the deal, they turned around and flipped the property for $18 million and made a very, very healthy profit. I wish we'd come up a few $100,000 more, but we didn't. Anyway, that's an example of what some of these debt deals can look like. They have been very popular over the past few years, but what you are seeing now are more people looking to trying to get to the collateral, because the banks, frankly, they're a little slow to let some of this stuff out. They're not getting as much pressure to release the distressed debt, and as a result of that, it's kind of trickling through the market. So if you are going to pursue debt buy, a debt purchase, or a note purchase, keep in mind that it may take some time to finally get to something. So what are the pros? So what are the pros and cons on the debt purchase? Well, the pros are that you come in, you buy the debt, you foreclose on the property, you clear the title. It's fast. You're getting control, partial control, very quickly within 2 to 3 weeks. You also have a lower, you're lower in the capital stack, so you've got some room there between the market value of the property and the debt or principal that you are owed on the property. And you also have the opportunity to enforce recourse on the owner. You look for those personal recourse opportunities. If you see carve-outs where the owner has isolated himself or his assets from recourse, recourse is more limited there, and you'll have less leverage. The downsides on the debt buy, owners frequently will file bankruptcy, and when they do that, that can prolong the foreclosure process considerably and reduce your return on investment and increase your legal costs. Cons are that it's fast. Now that is a pro, but there's a downside here. You got to get your due diligence done very quickly. It's important that you understand the property if you're going to be looking at having a loan on it. So make sure that you do take the time to get your due diligence worked out so you know what you're actually going to potentially be owning. You do have a discount from the largest portion of the capital stack, and there's a lot of cash needed. This is capital intensive. Note buying is it's a fast-paced business, so there's a lot of money flowing around. Now on the other side, the collateral side, and this is the side of the business that we've decided to spend more of our time on because it's our expertise. The collateral, it's really the property itself. It's the improvement, and what I like about it is it's something that doesn't change. It's something that you can get your hands on. You also have a little bit more control when you're dealing with the collateral versus the debt. And I just like to know that when I'm going in to buy a property, I'm dealing with the owner of the property and not someone who's subject to what the owner may or may not want to do with the property. So on the collateral side, you're getting control of the property. The owner is giving you permission to negotiate with the lender. You want to make sure you get that in writing. And when you're purchasing property subject to the existing debt, you have some options. Sometimes you can go to the lender and you can assume the loan or reinstate it. You can negotiate a short sale or just restructure the debt altogether and keep the lender in the deal. So what's nice about that is that the debt has already been originated and you don't have to worry about going out and necessarily bringing in new financing. So here's one example of a deal that we were involved in. This was a deal that we actually did in our brokerage company. We were representing an owner who called us. He was in forbearance and asked us to advise and represent him, which we did. He owned a 30,000 square foot industrial building, had an expired forbearance coming due, and the forbearance had come due, it was expired, and he owed about $1.1 million. Now the structure of the forbearance agreement was that the owner had borrowed $1 million on the building, and then the lender, in an effort to avoid having to auction the property or go REO, bring the property back in as owned real estate, they opted to give him a $100,000 interest draw. So he opened an account, they funded it with $100,000, and that $100,000 was funding the interest that was due on the property. So the bank was in fact financing his default because they did not want to foreclose on the property. Now what he needed to do was sell the property and was hoping to, as every owner does, sell it for a lot more money than a buyer would pay off the bank, pay off his back interest, pay us, and then walk away with some cash. Unfortunately, that didn't quite work out that way, but we did bring in a buyer who was a cash buyer. He had an issue. He was exiting a 200,000 square foot mill complex where he was doing a 1031 exchange. He needed to replace some of that mill complex with some smaller properties so he could relocate some of his companies out of that complex into some industrial buildings. So he had identified this building, wanted to buy it, but needed some time, and unfortunately we didn't have time because the lender wanted to come in and foreclose. So what we wound up doing was we negotiated an option, kind of a lease option type structure, where we made payments. The buyer made attributable payments. So each payment he made to the bank on a monthly basis was credited toward the purchase price. And what that did was it kept the bank from foreclosing on the property, and it gave him time to structure his exit on his big sale. and then go ahead and do a 1031 exchange into this property. So what wound up happening was, as it took him about 10 months, and by the time he closed, he was already getting offers from other people for 1.4, 1.3, 1.5 million. They wanted to buy the property because the market was starting to pick back up. So he made a very nice profit on that, and he wound up keeping the building and moving 5 of his companies that he owned into that property and owning and occupying it. So that turned out well for everyone. The seller got out of the deal, got his cash, paid off, and didn't have any extra money, but also didn't have the bank barking up his tree anymore. The buyer got the deal, we got paid, everyone did okay there. Now on the collateral purchase, some of the pros and cons you're going to run into. The pros are you get the opportunity to get control of the property and work out a deal with the lender. There's usually less cash involved. You're not buying the loan, so you can come in and take advantage of some of the leverage that's in place. You also get access to the collateral. I like this. I like being able to go to the property, go inside the building, take a look at it. I want to know what's going on with it, so when I see it, I understand what I'm actually getting control of and what I'm buying. Now the downsides here, you've got difficulty you could run into in working out a deal with the lender. They may not be willing to work with you or reinstate or restructure. That may mean having to go out and bring in new financing. That can be a pain. You could have additional liens to be negotiated. This happens a lot. If someone's not paying the mortgage, they're probably not paying their other bills. So you may see municipal liens, tax liens, judgments, second mortgages, third mortgages stacked up on the property. And you may have to deal with some of those when you're going and trying to restructure the ownership of that property. You also have to assume that you could have negative cash flows. You could run into a situation where the owner doesn't have the tenant base to support a mortgage. So in fact, he's drawing down cash and you're taking over a property where you don't have adequate cash flows to service the debt. And that could be a problem. It may take you some time to stabilize the property, to find new tenants to come in, to take over the vacant space, and to get that property back into service. Now, when you're looking for commercial foreclosure deals, you could look for 3 primary things. One is the notice of default, or the default notice. That'll be filed at the registry. It's filed at the deeds, registry of deeds or county deeds records office. You can go there and look for those, or a lot of the online services these days do publish those live, so you can track them online. Forbearance agreements are also a great source of distressed deals. A lot of banks aren't necessarily moving quickly to go to a notice. They're in fact negotiating these forbearances, trying to protract or extend the foreclosure process. So when you go out and you're looking at the registry or public records office, look for forbearance filings as well. A lot of times a forbearance filing will also have the terms of the deal written into the filing, so you'll actually know how much money is involved in the agreement, how long the agreement's good for. And then lastly, a lot of banks like to file lis pendus, and what that allows them to do is to kind of quietly move into a foreclosure. They may not necessarily want a lot of people knowing about it. So we're going to go deeper into each of these 3. And first we're going to talk about that default notice. So the first thing that happens is that first payment that's missed, and usually a second or third payment's missed. And then what the bank does is they put the loan file into review. Default notices are delivered to all debtors, co-signers, and other stakeholders. Now, I've been in a situation where I've had second mortgages on properties where the owner of the property has defaulted on the first. I actually receive a letter from the first position lender notifying me that they are in default of their loan. And what I always do in my second mortgage deals is I write in a provision that says that if the borrower does in fact default on the first, I can accelerate my second and either exercise an option to buy the property or go ahead and take control of the deal, take out the first, and then get possession of the deed. So those notices do go out. Notice is then publicly recorded. That's where you're going to find out about it, and you'll see announcement of sale proceedings coming out, and that's where they start advertising with auctioneers that they are going to in fact foreclose and auction the property. The forbearance notification process is a little different. The forbearance is that agreement between the lender and the owner. It delays foreclosure, and it gives the owner the opportunity to catch up on missed payments. This is a popular tool that lenders do use, and the forbearance periods are temporary and often publicly filed. So the opportunity there is for you to get a kind of a sneak peek or a preview that there is an owner in distress, and there may be an opportunity for you to approach that owner to talk about structuring a deal that could take them out of the property and then get you control of the asset to make some money with it. Lis pendus, this is really kind of the quiet foreclosure. I have friends that are commercial lenders. They do tell me that they prefer this at times because it allows them to kind of come in quietly and put a notice that they are pursuing the borrower. They're filing a lawsuit, which is really what that means. Lis pendus is a pending lawsuit. They like it. It's quiet. It's quick, and they can go right into court with this to have their lawsuit answered. Now, what happens is in the foreclosure process is the lender will file the notice, and then the owner answers, cures, or reinstates, and that's where you could get involved and come in and start to work with the owner to maybe reinstate their loan in exchange for the deed, or get involved with the lender in figuring out a way to restructure the deal. The lender could then also pursue judicial foreclosure. They may choose not to do that, and they'll go non-judicial. But what you will see is a notice, and then finally the public sale. At any point in that process, you can get involved in the deal and enter the transaction. So, just because you come in late doesn't necessarily mean that you're missing the opportunity. It's always best to be early. But what I found in buying foreclosures is that owners tend to be in denial, usually for at least 3 months, and then after about 3 or 4 months, they start to have their kind of come to Jesus moment where they realize that things are really not going the right way for them, and they may have to start thinking about some alternatives. And oftentimes one of the first alternatives they'll think about is going to their attorney and then trying to create roadblocks for the lender to come and take the property. Well, you can step in there and get involved and help to structure a deal that does in fact get them out of there. Now, if you want to go directly to the banks and source debt or collateral deals, I've got a great online tool that we like and we use called Bank Prospector. You can go to distressedpro.com and check out their tool there. It is a subscription-based tool, but what it does is it gives you 3 ways to find banks and distressed loans. Distress Pro download data nightly from the FFIEC. Now, the FFIEC is the Federal Financial Institutions Examination Council. And essentially what that is it's the bank examiner's office, and they keep records on a regular basis of how healthy our banks are in the United States. And what this tool allows you to do is to go in and search those records by geography or by bank or by distressed asset, and then find out which banks actually have the assets that you're targeting. And then you can connect into LinkedIn or Jigsaw to find the contact people at the banks. Now, as you know, with the loan maturities coming up, you've got this big pipeline of loans that the banks are going to be dealing with. They do have increasing delinquency rates, as you can see from the chart here. The banks and thrifts, that green line shows you that there is an uptick in delinquencies. So as these loans come due, the banks are reappraising all the properties, and they're realizing that some of them don't have adequate loan-to-value ratios. They may not be able to service the debt they have. They've got some big issues there. One of the silver linings to the story is that interest rates are low, and it's allowing a lot of owners to maintain their properties and keep them because they're able to keep their debt costs fairly low. So they're just kind of floating along. but it doesn't take much for someone to miss a bump here and for you to find an opportunity. And when you're sourcing from the banks, you can go in, you can search by state. You can take the target market that you're focused on, search by state, and then you can go down by asset type. So for example, if you're interested in multifamily, you can search by multifamily. I like this a lot because it gives you the ability to sift and sort and get to the list of banks that really have the most opportunity for you to access. And when you go in there and you start targeting these banks, you're going to find which ones are most likely going to be sellers. And when you contact them, you're going to have something very meaningful to say, and that is, I understand that you may have some distressed assets in your books, and I understand that you may be considering selling some of them. Here's my story, here's my strategy, here's my why, here's what I'm about, here's what I'm doing. Does it make sense for us to have a conversation about some opportunities to do business together? So when you're looking at pursuing the banks, this is a phenomenal tool to use. You can go to DistressPro.com, enter CRE Invested as a coupon code, and just check it out. They do have a great service, and I do like it. Now on CMBS, there's another component to this lending universe, and CMBS is a commercial mortgage-backed security. It's shown here by that orange kind of wave, and you can see that's a pretty big dollar amount. What the CMBS market is it's made up of really securities or bonds, and these are backed by commercial mortgages. So when you go and you get a commercial mortgage, the bank takes that loan and they sell it off, and that loan is then cut up into pieces or tranches, and those tranches are sold into the securities market. So bond investors say, I want to buy a portion of the debt at the lowest section of the capital stack, which is the safest section, and I'll take a low interest rate on it. And then you have other tranches that are higher up in the capital stack, and those are the higher risk or higher interest rate opportunities for bond investors to buy in. Now what happened was there was a lot of CMBS debt that hit the market, and as investors started buying these up, they were receiving dividends on their bond investments. And what ended up occurring was a lot of the loans went into default. When they went into default, all of these bondholders needed someone to help restructure the deals because they weren't getting their yield. So this is where you come in, and you're interacting with the servicers that are involved in these CMBS loans. So there are three types. You have primary, master, and special. The primary, that's the person who has direct contact to the borrower. The master servicer, they service the pool of loans, so they're up higher from the borrower looking at a whole bunch of borrowers. And what happens is when the borrower defaults, they get kicked up to the special servicer. The special servicer has a watch list or has all of the defaulted loans, and their job is to monitor and to try to figure out an exit strategy to take those defaulting loans and get them off the books. So when you're dealing with this space and you want to be in the CMBS world, one of the things you want to do is work directly with the special servicers. They are very busy, they're overwhelmed right now, and if you're going to contact them, you want to make sure that you have a very clear strategy on how you're going to communicate with them, and you can develop that messaging using a lot of the tools that we've talked about in previous modules. There is a data source that we like. It's www.trepp.com. That's TREPP.com. They're a CMBS monitoring service, and what they do is they give reporting on what's happening with CMBS loans. What's great about that service is you can go in and search by geography and asset type, and you can actually see some of the updates that the servicers are providing on the loan. It's a monitoring service, so you're getting a lot of transparency into what's going on. What I can tell you is what you'll see is not the entire story. We recently were involved in a CMBS note auction. We were looking at a 283 CMBS portfolio that came to market. The challenge with this was that it was a monster portfolio. It was like $800 million in loans, and there was much larger than anything we deal with. But what we were looking at was a portion of it in the Northeast. So the auction had come out, and bids were due in 30 days. So we were required to do very fast due diligence, And what we did was identify 11 properties that we went out and performed due diligence on, site visit. We looked at the assets, we looked at the collateral, we looked at the markets, we looked at all of the loan file information. We did due diligence on the loans themselves, environmental reports that were on file, read all the special servicer correspondence. So that's a special servicer and the borrower talking to one another about what's happening with the default. And then built out our financial pro forma summaries that allowed us to figure out, is there a future to this asset, and if there is, what could we pay for the loan, foreclose, take possession of the property, and then add the value to it. So out of the 1.1 million square feet that we actually looked at, we concluded that about 50% of the properties were of interest, the rest were junk. What had happened in this auction was a lot of the properties came through as junk that were packaged in with a few good ones, and you're going to find that happens a lot with note auctions, where lenders will try to put a couple carrots in to entice you to bid, and then they'll try to offload some of the dogs in the process. So one of the things you want to be careful there is make sure you do your due diligence. Now, when you go into the auction space, here's how they work. The bank typically will go to the auction, and they've got two strategies. One is they want to find out what's going on in the market, and the second is they want to clear the title. When they have a value from the auction, it allows them to take the property back, they own it, the title's clear, and now they can do what they want with it. Some banks will go to auction to sell, and it's nice when that happens, but it doesn't always happen. I'm sure if you've ever been to an auction, you've seen the bank show up and they actually end up bidding. They send a proxy, sometimes an attorney, to bid on their own behalf, and they end up buying the property back. But ideally, the bank does want to sell. They don't want to own the real estate. So when you go to auction, you want to make sure that you understand what it is that you're going to be buying. Now, one of the other reasons why banks like auctions is because it pools all of the demand that's in the market into a fixed time frame, and it gives that set of buyers a deadline that they have to come in and perform by. Don't get trapped by the excitement of the auction. If you look at auction metrics, what you'll actually find is that many auctions end up they net the seller 85 to 90% of the market value, so there's some discount to be had. But what's surprising is that most buyers and investors believe that because an auction's happening, there's a deal to be had. But that's not necessarily the case. Auctioneers will tell you that they quite often sell for pretty high values, and that's one of the value propositions that they give when they go into the bank to talk to them about taking a deal to market. So they can be good deals, but they often offer limited flexibility and due diligence opportunities. You're often buying as is, where is. That means you're getting the property the way it comes, and we're not warrantying anything. So make sure that you understand the asset. You will probably be competing with other buyers, and you want to make sure you have your financing lined up, and be prepared for surprises. Your deposit will be necessary. You'll have to have that ready to go in order to register for the auction, and then you're off to the races. So what happens when the auction occurs and the bank ends up bidding and they buy the property back, or no one shows up and the bank has no option but to take the property back? Well, what they do is they close on the property. There's no bidder, so they clear the title. They then take the title back, and they will then either privately sell the property, or they'll put in place some sort of management plan to reposition the property in order to tenant it, or maybe clear the tenants and then sell the property into the open market. Now, if you're an auction guy and you're going out to auctions because you like to flip deals, one of the things I want to emphasize is how you can manage your risk there. The very first thing you need to do is make sure you have your buyer or tenant list set up, and you can do that by creating a database of people that are looking for deals similar to you. The second thing you want to do is get control of the deal. always make sure you have financing lined up, because when you do go to the auction and put down that deposit, you sign that purchase contract, that deposit is hard, you're not getting it back. So you want to make sure you protect yourself. Now when you build that buyer tenant list, start with everyone you know and build that database up. Write down or catalog all the buyer preferences in your market, and prep your prep your broker list for notification of the deal. If you get control of it, you want to go out to your core brokerage community and let them know that you have control of an investment deal. Once you've done that, you can go into the press. You can collect names of investors there. Commercial real estate investors like to brag about deals they've done, and you can call recent deal makers to see if they're interested in deals that you may be uncovering. Here's an example of a sale announcement. This was just a kind of a brag rag announcement that came out. But what you'll see here are the names of all the people who are involved, as well as the companies that were involved. And it's not too hard these days to find out, for example, who's in the LLC and who owns the property. So you find the seller, you find the buyer, and then you can go ahead and look up that information and then call them or add them to your buyer list. Another buyer list tip: you can hire a virtual assistant or a researcher to help you with this. We use virtual assistants on odesk.com. We'll often send them research work to do for us when we're looking into a specific market opportunity. Recently, for only $100, I hired a virtual assistant to build a list of 6,000 plus transactions since 2004. And what that had was all of the announcements that had come out in a popular real estate journal announcing the lease and sale transactions since 2004 on a monthly basis. So I had the researcher go in and pull all of that data down, dump it into an Excel sheet, so I could go ahead and search through it and see who all the parties were, the size of the deals that were done, where they were located, how much money was paid, the brokers that were involved. It was a tremendous tool for us, and we use it for our market research here when we're looking at deals. Now, when you do get the deal, you want to make sure you have your financing lined up. You can have a hard money lender ready to go, you can have private money ready to go, or some other transactional funding source to protect yourself, and be prepared to close on the deal. So if you have the funding ready, you want to go ahead and be lined up. But to further protect yourself, you need to have a confidentiality agreement. So call or email your buyer list, probe for interest, and then verify the qualifications and send them a confidentiality agreement or non-circumvent agreement. You don't want them sharing the details of your deal with everyone in the world. So send them a CA or a non-circumvent and ask them to sign it before you send them any information. You can also share with them your plans to assign the deal after they've signed it, and then you can collect your assignment fee up front if they decide to step into your shoes and take over your purchase agreement, or get paid at the closing. And if you are paid at the closing, be sure you're listed on the settlement statement. So you want to contact the title company or the attorney handling that closing for you and make sure they add you there. So that's it for commercial foreclosures. Here's what's up in the next session. We're going to be talking about qualifying the owner. In this module, qualifying the owner, I'm going to give you a 6-step process you can follow to qualify an owner and to uncover some motivations for selling. I'm also going to give you a psychological technique that you can use called FIFA. This is a very, very powerful technique that you can use to uncover the emotional side of why an owner's selling, and then also how you can ask them to give you the roadmap for how to make the deal happen. So after that, you're going to learn about building relationships, managing the money conversation, how to ask for the right amount from the owner, what they want to sell for, and how much you may want to offer, how to have that conversation, involving stakeholders and decision makers, making sure that they're all a part of that conversation, and then in the end, structuring your deal. So again, this is Jeremy Serrier. You're watching Module 8 of CRA Invested. I look forward to seeing you in Module 9.